Hello traders, Joseph here again. Thank you so much for joining me on today's video. Now, have you ever asked yourself this question? Why is it so hard to make money in Forex? If only there could be a straightforward answer. But I'm going to try and give you some clarity in this video. Now, if I ask you a simple question, what do you think are the three most important skill that any trader needs in order to be successful at trading? Well, can anyone tell me? Yep, I see you thinking. What's that you're thinking? Good strategy? Yep, you're correct. Having a good strategy is important. But what is a good strategy? A good strategy is basically a strategy that has clear rules and it's simple and easy to understand and trade. And the second one, can anyone tell me the second one? Yep, I see you thinking over there. Emotions, did you say emotions? Yep. So emotions, controlling your emotions is important. That's the psychology part of trading. You have to be able to control your emotions and keep your emotions in check when you're trading. Because you can't eliminate your emotions. We're humans, we all have emotions. So you can't eliminate it, but you have to learn how to control it when you trade. Okay, and what's the final one? Can anyone tell me the final one? I'll give you a couple of minutes, a couple of seconds to think about it. 1, 2, time is up. Did you say money management? Absolutely. So risk or money management is the most important out of those three. Because money management is the icing on the cake. Money management is the foundation for growth. Money management is the one that links the two together. Money management keeps your emotions in check, and money management brings results from your strategy. Now I'm going to take the most common strategy that everyone who knows about Forex trading can understand. And this strategy, by this strategy I mean it's just a simple trend continuation, or if you like to call it break and a retest, or kind of support and resistance. So it's all those three rolled into one. And I'm going to show you why, if you're going to trade that strategy and you're sticking to the, I'm sure most of you guys have seen, you know, or have come across what people will tell you, oh, if you want to be successful at trading, when it comes to money management, you should only risk 2% of your account on every single trade. So I'm going to show you why, if you're going to trade and follow those rules of risking 2% of your account, you're never going to be successful at trading. You're never going to make money at trading. So let's look at this strategy in more details. So I've got a simple, so you're looking at the chart here, no indicators, no nothing, just a plain chart. Just to kind of understand, you can look at the movement of the market. You know, the market made an impulse leg, nice correction, another impulse leg, nice pullback, and a new high. Yeah. So what I'm going to do is I'm going to kind of cut the market from here. I'm going to cut it from here. So now we have this. So if you're trading and you see this, so where the market gives you a nice impulse leg, and you got a nice little correction here, a nice little pullback, a nice little structure here, and then the market makes a new high, and then you're starting to see the market comes back down a little bit. Now, if you understand trading, if you even know the slightest bit about trading, you would know that this is what we call support. Everyone that's watching this video should know what support is. I mean, at this point, it becomes support. Previously, before we broke to the upside, it was resistance. Because we had a point where the market came in, respected that resistance. The first time, the second time, and the third time it did respect it a little bit before it finally broke to the upside. And now the market is coming back down. So that resistance is going to act as a support. Yeah. So if you're a trader you would position yourself in a place to go long. And the idea is that if the market comes back down to this level, you're going to look for an opportunity to buy. So from this moment in time, you're going to start planning your trade. So you're going to start, let's plan a trade. Let's see if we can plan ahead and kind of, you know, think of what to do and then how to kind of trade the market. So what you're going to do, the first thing you're going to put is the fact that you're going to sort out where your stop loss is going to be, because that's the most important thing you should do before you place a trade. Where's my stop loss going to go? So let's use the analogy that you already familiar with, where people tell you to risk only 2% of your account. Yeah. So if we were to buy this market at this support level, assuming the market comes in and gives us the signal to buy, the kind of the reversal signal that you may be looking for. So you're going to put your stop loss. Your stop loss has to go below the previous structure. So this is the previous structure here. So your stop loss has to go way below that previous structure. Now how low the stop loss you're going to put your stop loss depends on a lot of people, depends on your style of trading. But the most common way to do it is to put your stop loss at least 15 or 20 pips below this previous structure, just to kind of give you some breathing room, breathing space. So we're going to put our stop loss all the way at 137. So let's make it 137. So we're going to put our stop loss all the way at 137, right? And in terms of the profit, where you're going to put your profit, well, we can look at what the market has done in the last just before we got to where we are right now. We can look at this impulse leg, look at this correction, and look at where the market went to, and we can just look to repeat. We can expect the market to repeat the same thing in terms of coming back down, giving you a pullback, not necessarily like this one, but any kind of a pullback, and then another move, creating a new structure high. So in the previous scenario, if you bring in your Fibonacci, swing low to swing high, and you look at the Fibonacci extension, we can see that the market came into the 141 extension, and then it's starting to pull back. Okay, then we can see. So we expect the market to do the same thing. So you draw your Fibonacci from the swing low to the swing high, and then you're expecting the market to come into the 127, or let's say the 141 extension. This is where we're going to put a stop loss, 141 extension. So we can see that straight away we have a risk to reward ratio of exactly 2 to 1. And this is absolutely perfect. This is amazing, right? If you were to trade like this, if you were to find a trading opportunity like this, it's gold mine. In trading, risk to reward ratio of more than 2 to 1 is gold mine. But this is not going to be the case, is it? Why is it not going to be a case? Well, because first of all, you're not gonna buy the market at that exact same price, unless obviously you put a pending order to buy. But obviously, I'm assuming you have a little bit more experience. So in that case, I'm assuming that you're a trader who is gonna wait for the market to come to this entry point, and then look for kind of like an entry signal, maybe like a higher high, higher close on a candle, or a reversal structure, or kind of a, you know, anything to do with your indicators, or so, you know, your RSI, your oversold conditions and things like that. I would expect you to have some kind of experience. Yeah. So if that's going to be the case, then you wouldn't get that market. You wouldn't get that. It's very hard for you to get that exact same price. As we're going to see, obviously, once this happens, we're going to see. So what I'll do is I'll play this market a little bit, and then we're going to see what where our exact entry point is going to be. So if you play the market, you can see, okay, the market's come back into the previous structure, and we're getting some kind of a rejection. So at this point in time, we'll wait for the market to give us a higher high, higher close on a candle, and then we'll look to. So there we go. So at that point here, you can see the market has given us a higher high, higher close on a candle, a nice rounded bottom on top of this support level. So now we're gonna go ahead and place a buy, right? So if we were to place a buy at that level, that straight away changes our risk to reward ratio to just over 1 to 1. So from 2 to 1, your risk to reward ratio has gone down to 1 to 1, almost 1 to 1. But we know that there's spreads. You have to account for spreads as well. So even if you place a buy on your account, it's not going to buy it at that price. The buy price is going to be, well, this is the pound yen, so we're looking at the spreads of at least 4 or 5 pips, depending on your broker. So 138.19. That's where your order will be executed. And all of a sudden you can see that your risk to reward ratio from going from 2 to 1, now you have a risk to reward ratio of almost 1 to 1. Okay, so let's say you have your trading account of £1,000. So now it's gonna get really, really technical. So I hope you guys are gonna pay close attention. So you have £1,000 in your account. This is your first trade. Risking 2%. So it means if the market goes down to that level, you're gonna lose £20, right? You're gonna lose, where's the pound sign? Where's the minus sign? Yep. And you're gonna lose £20. Let's put that in red. You're gonna lose £20 of your account. The market goes to your profit level, obviously 0.98. So your profit is gonna be £19.60. So £19.60. Put that in green. Okay, so I mean, even with this, if you were to trade this strategy, I think you can all agree with me that at least 60% of the time your profit level is going to be hit. Yeah, so let's do some math. So you take 100 trades, you win 60 and you lose 40. So 60 wins will give you a total profit of 1,176, and then 40 losses will give you a total loss of £800. So you're left with a net profit of 376, which is around 38% profit, right? So 38% profit on your account. 38% profit on your account. Now this is not too bad. Making 38% profit is not too bad from 100 trades. But do you know that you will never make that amount of money even if you follow that strategy? Why is that? The only way you can get this amount is if you program this strategy into a computer and you let the computer trade. Then you're gonna hit that 38%. Because once you tell the computer, okay, this is what the computer needs to do, this is where the profit needs to take, and that computer can be consistent and keep executing that trades. But if I put you into that hot seat and let you do it, you're not going to get those results, because when the emotions come into play, everything changes. Because there's going to be times where the market will go close to your profit level and it's going to reverse, take you out on a loss. There's going to be times where you place a trade and straight away you see your account going into minus, and then you start tempering with your stop losses, start moving it a little bit, expecting the market to reverse in your direction. And at the end of the day, you're going to go through a period where you have drawdowns. That happens in trading. So let's say you're trading with this, risking 2% of your account, and you lose 10 trades in a row. If you lose 10 trades in a row, that's going to give you a drawdown of around 20%. Do you know how hard it is to recover after losing 20% of your account? So let's take a look at this table. We got a table over here. And this table is a table that tells us how hard it is to recover after losing a certain percentage of your account. So if you lose 25% of your account, you're gonna have to make a profit return of 33% in order to get back to break even. Now we just looked at a very simple method where you're gonna trade 100 times just to get 38%. And now you're saying if you lose 25% of your account, you're gonna need those 100 trades, close to those 100 trades, in order to get back to break even. Let that sink in. You lose 50% of your account, you can forget about trading. And you can see how the numbers are. So anybody that tells you that you should only risk 2% of your account to trade whenever you're trading, don't listen to those people, because they've never traded in their lives. So if you ask me, so how much should I risk when I trade? I can't tell you how much you can risk, but what I can tell you is that when you're trading, your stop loss isn't meant to be hit. Excuse me? I hear some people say, excuse me, what do you mean? What do you mean my stop loss isn't meant to be hit? Yes, you heard me right. Your stop loss is not meant to be hit when you're trading. So what I mean by that is, let's take this example and analyze it properly. Yeah? This is where your stop loss is supposed to be. If I was trading this strategy, this is where I would aim to get out of the market. This level. And this is where my stop loss is going to be. Let me show you. Profit same level. And this is where my stop loss is going to be. My stop loss is going to be somewhere there. This is where I'm going to take 2% of my account. And at this point, I'm going to take 1% loss on my account. So this one is going to be back to £10. £10 and 40 pence, because it's 0.52 risk to reward ratio. Yeah? Now this does not make sense to a lot of people. The reason why this is this way is because I manually close my trade once I know that I'm wrong. My stop loss is there to protect me in case of like huge market movements. So for example, there was a non-farm payroll announcement when I'm not next to my computer and the market moves like 100 pips against it, 200 pips against me. My stop loss is there to make sure I don't lose more than 2% of my account. My stop loss is not there for me to be because you can agree with me that if you trade this strategy 100 times, at least you're gonna take 30 or 40 losses out of those 100. So that's 30 or 40 times that your stop loss getting hit consistently. So you're doing your trading the wrong way. That's not the right way to trade. You should only take 1% loss. But if you do that, then that's going to decrease your potential to even make the 38% that we just saw now. So you see how things are becoming a lot harder. Even with the 38%, sticking with the 2% is something that is impossible. You can't get to that level unless you trade like a machine. And you can't trade like a machine because emotions will always be there. And then you use this method where you cut down your losses, you cut down you make changes to your money management, and your returns is going to be it's going to be a lot less. That's why people that trade this strategy, the retail traders, that teach you how to trade resistance and support, trend continuation, break and a retest, you will never make money from those strategies. There's just no way you're going to be able to make money from those strategies. If you have a good money management to trade those strategies, maybe you can make a little bit of money. You can make a certain amount of percentage, especially if you trade like this. But if you trade with a 2% risk, then forget it. That's why having a good strategy is important. But having a good strategy that has a good risk to reward ratio, and you apply a good money management strategy to that, then you're going to be able to make decent amount of returns in Forex trading. So what kind of strategy can you use in this case in order to improve your returns, in order to maximize your potential returns? I'm going to show you. Have you ever heard of a strategy called the complex contraction? I don't think you have. That's because the complex contraction is a strategy that I'm the only one who teaches that strategy in my Zoom trading classes. And if you guys haven't signed up yet, go and sign up and I'll show you how the strategy works. So this one in particular is called the complex contraction, the pullback and continuation, or otherwise known as the 618. So what do we have here? We have a complex contraction here. The market breaking out of the complex contraction. We're getting a pullback back into the 618 retracement. We got a higher close here. We place a trade here. Take our profit at 1-for-1 extension. Our stop loss goes 10 pips below the previous low, and this is the low here. So you got your stop loss there, somewhere there. So all of us, so straight away you got 2.6, almost 3-to-1 risk to reward ratio. But using the same analogy that my stop loss isn't meant to be hit. So this is where my stop loss is gonna be. And this is where my profit is gonna be. And I still have a 1.57 risk to reward ratio. Now you do the math. If you do the math, this greatly improves your odds. It greatly improves your return in trading. But how many people know how to trade this strategy? Not many people, if you ask me. So if you haven't signed up to my trading classes on Zoom, head over to my website right now and book your spot. Like I said, this week I'm still going to be teaching what I taught my traders last week. I'm going to have an introduction and we're going to talk about structure. And then we're going to move on to the strategy itself from next week. So now you understand why money management, it's very, very, very important. It's the one that controls everything. It's the one that links the two together. So I really hope that, you're able to take something out of this, because it's going to make a huge difference to your trading. Absolutely. So thank you guys for watching this video. Thank you guys for for your continued support. And if you like this video, don't forget to share it, hit the like button, subscribe to my channel, and I'll see you on the next video.